You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry. We've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, there it is. The funkiest tune for the funkiest show here on the Options Insider Radio Network. What better way to close out your trading and indeed your broadcast week here with TWIFO. This Week in Futures Options, the program where we break down all of the fascinating activity going on the other side of the fence. So out there in the realm of crude oil, maybe some gold, maybe some soybeans, maybe a sprinkling, a smattering of some other products out there that catch our eye and stir them all together. With your questions, your comments, some flash polls and pop quizzes and some crazy trades and all sorts of fun stuff. Stir it all together. You get the tasty, tasty brew. That is TWIFO. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Many, many programs, including quite a few archived episodes of TWIFO for you to enjoy at your leisure, wherever you are. But the easiest place to do all that, as well as, of course, read up on some fun futures options and regular options content as well, over there, the mothership, the flagship, theoptionsinsider.com. Got breaking news from the world of options, headlines, articles, analysis, unusual activity, all sorts of fun stuff for you guys to consume. And when you're done doing that, click on that Insider Radio Network tab, and that's when your audio journey has begun. And of course, in addition to TWIFO, 14 other programs for you guys to choose from. You can always get us via your other platforms as well, iTunes, TuneIn, Stitcher, pretty much wherever you guys find the show. And it's a new program, so if you guys like what you're listening to, hey, leave us a nice little review there on iTunes or TuneIn or wherever you like to listen to the program. Can't hurt. We like to see those filtering in. Let us know what you think about the old program here. We'd love to hear from you guys. Of course, you can always hit us up on the website or via social media at Options or at The Options Insider on Facebook or Options Insider on Stock Twits, or just hit us up the old-fashioned way, questions@theoptionsinsider.com. And it's all baked into the mobile app if you can't remember that. Don't worry. Download the app. It's all there. You can hit us up, your questions, your comments, your insights, your pearls of wisdom for us, as well as for your fellow TWIFO listeners. And I'm joined on the old TWIFO program once again by my futures options nemesis, my partner in crime, the yin to my yang, Mr. Nick Howard, the founder of Bantix Technologies and the creator of a wee little bitty program we like to use around here quite a bit called QuikStrike. Nick, welcome back to TWIFO, This Week in Futures Options.
Hey, man. I am here and ready to go. I can't believe it's Friday already. It's a very quick week.
The week does fly by when you're looking forward to TWIFO, does it not?
It certainly does.
All right. So let's kick it off. Let's start TWIFOing. Let's make that a verb. I like that. Let's just create that as a new verb. TWIFOing. I like it. Let's kick things off in the black tar, the Texas tea, the place where I know a lot of you guys are really spending a lot of your days watching, because I can't blame you. It's been fairly active, certainly for the last few sessions, and for the last pretty much almost 2 years now, crude has been kind of the dominant commodity story, and continues to be an interesting one. Of course, recent weeks we saw the Saudis come in, talking up a bit of support. People have been waiting for that for the better part since the sell-off pretty much began. So we're seeing, is that perhaps the point, the inflection point everyone has been waiting for, or does it going to take a little bit more? Of course, we've seen interesting evolution. By the way, I forgot to mention, top of the show, we do indeed stream it live, Mixlr, MIXLR, every Friday, 3 p.m. Central, 4 p.m. Eastern, if you're so inclined, you'd like to join us there. Or, of course, if you want to follow along, not just with the live stream, but with the reports, all the data Nick and I talk about here, you can get it for free, cmegroup.com/TWIO. This week in options. And if you do that, like I am doing right now, you can pull up this data for yourself. You see net out there in WTI futures. It was off about a point and a half across most of the term structure out there. So hovering around the high 40 handle, kind of people looking to see if 50 is indeed the next level that WTI can reach. If all this Saudi talk will get us up there, if we're going to retreat back into the mid to low 40 range again. A lot of interesting stuff out there. We'll kick it off with, overall, it was a pretty active week from a WTI perspective. Open interest up about 5%, or about 100,000 contracts, a little more, 107,000 contracts this week. So fairly active week, even though WTI has been fairly active. It's nice to have the commodities kind of lighting it up a little bit. When out there in broad equity land, there isn't a heck of a lot to really parse. We are indeed in the summer doldrums, so commodity is one of the few rare bright points out there from a volume and an activity standpoint these days out there in options land. And if you're wondering, what was really lighting it up, what was the active contract out there in WTI land? Well, it was one contract, and one contract only. One contract to rule them all, and that was the OCC 50 calls. I was talking before about a lot of people fixated now. It used to be the 40 strike. Now it seems the 50 strike is where that attention is aggregating, and that wound up with about nearly 50,000, about 47,000 and change of those OCC 50 calls going up this week. The lion's share of those, almost half, going up on Tuesday, with about 21,600 going up. The rest of them kind of spread out throughout the week. Wednesday also about 15,000. So Tuesday and Wednesday accounting for about 38 of that 47,000. The rest kind of smattered out there throughout the week. So that was number one with a bullet. You got to go a lot farther out and down to find the next closest strike, and that was the OCC 45 put. Again, surprise, surprise, front month, where all the action was. Again this week, 62% of all volume coming in that October contract. 28,000, nearly 29,000 of those OCC 45 puts. Also lighting it up this week, fairly evenly spread out across the term structure. Then it kind of falls off again with the OCC 49s coming in number 3, 17,000 and down, and so on and so forth. So front month and 50 calls was pretty much where the action was this week. I know a lot of people like to ask us about our crazy trades out there. We'll get to that in a little bit. We have some interesting candidates for that. Before we do that, Nick, maybe we'll dive into some of the things I know have been catching your eye out there in WTI as well. I know you like to look at that little max pain indicator, so we can always hit on that. And of course, if anything caught your eye out there in a quick skew perspective, looking at what's going on out there in a volatility skew, that's also of interest. And then we can discuss your suggestion for crazy trade of the week. Have at it, sir.
Yeah, so I just tweeted the open interest chart for October, and you'll see that the 45 strike and the 50 strike are indeed the max open interest for both the call and the puts, or the puts and the calls respectively. So you'll see the thatching if you're out there looking, or if you go out there and look later on. I did mark it with hashtag TWIFO, at options, at CME Group, et cetera. So you'll see that that's where a lot of the action is. And as Mark mentioned, that those were the big strikes du jour, or how do you say du week, of the du week? I don't know how to say week in French. So somebody
my
French
out there my French is weak. I know du jour as well.
Du semaine, maybe is it semaine?
Maybe.
It's semana
Maybe.
in Spanish.
Sounds good.
Du semaine. So the strike du semaine. Don't know. Correct us. So this is a new addition that we made to the open interest tool, which is out there for free on the CME Group website, where you can see very easily where the big OI numbers are. And like we've been talking about for the last few weeks, the range of the underlying, and in particular when you're taking a look at the front expiration, the range of underlying is tending to be within those buffeted areas there. So the 45 strike has overtaken the 40 strike over the last 10 trading days, and like Mark mentioned, the 50 strike had a big number in terms of volume, and it also had an opening in open interest, or an increase in open interest throughout the week. So it seems to be those are the barriers right there. To go quickly into Mark's mention of the max pain strike. So if we take a look at that, and again, if you want to read about what max pain is, we can tweet out that link again, so you could take a pretty good look. But right now, where the biggest losers across everybody who has premium in the October contract, the max pain would be a settlement strike of around $46. So we're right within that range. So if you're looking at max pain, 45 to 50, that's a painful range. 46 being the strike that's going to cause the biggest problem from the most losers in terms of the premium purchased and out there in the market. As far as some other interesting things happening, as Mark mentioned, there was a big increase in the OC and the NOV open interest. That's where a majority of the action took place this week. Overall, there was an increase as well, with the majority of the increase taking place in the first 6 contracts. So you'll see starting this weekend, Sunday night, the TWIFO report is going to have the first group of expirations or a minimum of 6 contracts. So it's going to have the first year or a minimum of 6 contracts. So when you come in there the first time this week, and you'll see 6 contracts, and you'll notice that the majority of the open interest change is coming from OC, NOV, DEES, and then Jan, Feb, and March. Really nothing super spectacular in terms of interesting strikes in the October. In the November, there were some open interest openings in the 60 and 65 strikes, with a majority of the volume being new open interest. So 60 strikes traded a little over 5,000 contracts, and there were about 3,200 new opening positions in that strike. And then for the 65 strike, about 3,800 traded, with 35 being new positions. So there, some play on the upside there in the November contract. As far as do we have a crazy trade bell or anything like that? As far as our crazy trade bell,
we need a drop for that. Maybe we'll work on that for upcoming shows. Our crazy trade of the week. How about that?
I just hit my letter opener and my scissors that I got as I think that was a gift for my brother's wedding.
Close enough. We'll get some sort of drop for you soon.
Call it. It's some sort of ring-a-ling-ling. So as far as a crazy trade, the only thing out there that looks anything remotely insane is the January 99 calls. So that's F contract out there on the report. The Jan 99 calls, that trade was for opening on Wednesday the 24th. And let's see how many we got there. We can click on that. And the Jan, he said to fill time. Where is it? Come on. What time is it? 3. Oh, we must be doing a run. Here it comes. There we go. Jan 99 call. So 500 traded on Wednesday, and there's 500 openings. So again, I always wonder who's buying that stuff, and I think it's like a penny. I think that was the size that I looked at, and that was today, and I think it was also Wednesday. So, but there's your big opening. Some trade in the 70 strike, but not much. But that's our crazy trade. I think that's going to be our winner because I looked, and there's really not much. There's not much crazy going on. Everything seems to be trending sideways for the most part. Other things to note, put call ratio basically 1 for volume this week. So pretty much steady state in terms of what people think. Still not quite sure, regardless of the prop up by the Saudis or whatever. I still think just based purely on looking at the numbers and the charts and stuff that we're sort of trending, but we can leave that for the professionals to see what they think. Still a call bias in the open interest, and it's going to be like that for a while until there's a change. And that's, you see some in the smaller open interest expirations, you see some put bias, but overall in contracts that have been trading a while and that have a larger open interest, you're going to see there's generally a call bias. And then as far as vol and skew, vol's pretty steady. The skew was steady as well, still a big put bias. So as far as the QuikSkew goes, you still see a big wide gap between the calls and the puts. And when we say the big wide gap, we're generally referring to the fact that the puts are rich to the at the money and the calls are a bit cheap, not super cheap, but a bit cheap. So we're still seeing a big channel that's going on. Mark, if you know what I can do, I'm going to, as I'm talking, I'll get a new screenshot of this and I'll tweet out this latest QuikSkew chart for the October so people can take a look at this. And what else do we have? Futures are rangy, still within that band, and I think the pretty obvious statement is it's going to be within that band until there's some news to push us outside there. So, Mark, do you want to mention something about I think you had some good info about the WTI skew versus the USO skew.
Yeah, it's an interesting thing. We don't talk a lot USO here on the program because obviously the name is This Week in Futures Options, so we mostly focus on the futures options. But we know a lot of you guys like to play in the ETFs as well, in the commodity ETFs, and they don't get much bigger than USO. A lot of you like to use that as your surrogate for your crude exposure. Clearly, it's not a perfect product. There are issues with it. We've detailed that on other programs in the past. But for a lot of you out there, it's kind of one of the few games in town from a commodity exposure perspective. So I like to look at that every now and then to see how things are lighting up. And as Nick was saying, you guys too can find what's going on in the skew over there on cmegroup.com/TWIO. Follow along, click on WTI, and play along on the vol tools. And you can look at what we're looking at right now, which shows you that the volatility skew is heavily biased yet again towards the puts out there in WTI. Perhaps not exactly surprising, even though the 50 calls were lighting it up, and you see that reflected in the near-term bid for some calls. But longer term, the puts are leading the charge. That's where a lot of people are concerned. You're seeing people lighting up puts and buying them all the way down south of the 45 handles. So clearly some concern about a retracement here over the next few months out there in WTI. What's kind of caught my eye, though, is we do a lot of programs here on the network looking at a variety of different ways to look at skew. And we looked at USO not that long ago on one of our programs, and USO is trading around $11 or so right now versus WTI, which is in the high 40s. And yet there is a even much stronger, remarkably strong put bias out there in WTI, USO, which is kind of interesting given the fact that, just structurally, it's an $11 product versus a $48, $47 product. So you'd think one would be a lot more attractive from a downside perspective than the other. And yet, if you look at any graph of the next 6 or so months out there in USO, from a skew perspective, it's extremely steep, all puts all the time. As we noted last week, there are a few notable exceptions. One of them has been the Jan cycle out there in USO, where there was obviously some heavy call buying out there because that was the one month that had a pretty bid up call wing out there. Clearly, someone loading up on some upside in USO out in the 15 handle and beyond. And clearly that reflected in the skew this week, because we're seeing a little more coming out as some other months are starting to catch. It looks like April catching a little bit of a bid as well. 1 month can't really remain aberrant out there by itself for long. Something else is going to happen. Someone's going to trade against that and spread it, and you're going to see evolution in that skew as a result. But so far, that's what we've been seeing out there in USO land, which is kind of interesting to see. I think you would expect the opposite. You'd expect the skew in WTI to be far more aggressive from a put perspective, and yet so far at least good old USO leading the charge out there. And I like your nomination, Nick, for the Jan 99 calls. Someone's opening on the 99 strike by January. January may sound like a long time away, but it isn't that far away. So they're effectively doubling down that WTI is going to double between now and Jan. Granted, it's only like a penny, so it's not like they're betting the bank, betting the farm there. But still, it's when you start seeing these bets start trickling in, maybe, I say maybe with a big cautionary note, maybe that is a sign of perhaps a broad turn in sentiment. Of course, the options skew would perhaps indicate a little bit else. Speaking of USO really quickly in here, Nick, we put up a question of the week this week, and it's just going out. It's just expiring as this show is finishing up, so I wanted to touch on it. At the beginning of the week, we asked people, hey, USO, we're trading about $11, up 19% in August. The SEP at the money straddle was trading for about 80 cents. The 10 put in USO, the SEP 10 put was trading for a dime. The SEP 12 call for 9 cents. So we asked you guys, what would you rather do? Would you sell the straddle? Would you buy the straddle? Would you buy the put, or even gave an option, a combo option of buying the collar, which is, of course, buying the put, selling the call, listeners, or turn that around on his head, sell the put, or sell the put, buy the call, a.k.a. a bullish risk reversal. Nick, if you can resist cheating, I know it's hard because you have the answer in front of you. What is your guess, and then what do you think won our poll?
Oh, I cheated, so I'm not even going to answer, but I probably, I don't know. I would have, if I was going to sell, I probably would have sold the strangle, but I cheated, so I know what the answer is.
Cheater, Nick the Cheat. That's going to be your new nickname for you. Yes, sell the straddle, winning with about 35% as this poll is winding down. Another couple hours to go. Buy the straddle, close number 2. 31%. I guess that's what makes the market. People want to sell the straddle and buy it, so they're loving that. Only 15% want to buy that put / collar. 19% attracted by that put juice. They want to sell that put or trade the bullish risk reversal. So interesting stuff out there in USO land. But let's keep moving on. I don't know, Nick. Let's. How about this? Let's go on to a name that's been a product, I should say, that's been top of mind for us for quite a while. It certainly was raging back a few months ago into the May, June, July timeframe. That seemed to really be when soybeans were dominating the conversation at a time when vol was not really that easy to come by. Soybeans were a demonstrable source of that. And they were also lining up very favorably, as you recall, Nick, for collars, which is if you were a long futures holder, you want to come in, buy a put to hedge that long futures position, turn around, maybe write some upside to finance that put. Collars were very attractive then because the puts were cheap, the calls were expensive. You can even do them for credits if you set them up aggressively. So it's always nice to get paid to hedge your position and also guarantee to sell on some upside. Those are always attractive things. We talked recently on the program about how that collar setup, not so much. It's kind of wound down a bit. So if you were looking to really light up those collars out there, you kind of missed your opportunity. And you might have wanted to have a collar on this past week because soybeans took it on the chin yet again. You know, Nick, it seems like you can't go another couple of weeks without some sort of limit or near limit move out there in the beans. They were net off 37 handles this week, Nick, nearly 4% out there in soybeans land. So just a crazy week. Despite all that big movement in the underlying, open interest pretty much unched on the week. So it wasn't like it was a corresponding big spike in soybeans open interest. But as we see all the time out there in soybeans, a lot of these ag products are dictated by their planting and harvesting cycle. So Nove is always the leader and not the front month out here in soybeans. And that is the case yet again with Nove taking 3/4 of the volume out there this week. Really, really lighting it up. And if you're wondering, are people out in soybeans land, are they as obsessed with round numbers as they are in WTI? Well, the answer is yes, they are. It was the SEP 1000s, the calls out there that were led the charge this week with about nearly 11,000 contracts going up out there this week. And overall, with all that massive sell-off, we saw vol coming off across the board. Also seeing the skew coming off across the board. Again, kind of reflective of the puts traditionally, at least of late, out there in soybeans have been a little bit lower volatility regime. So if you're moving aggressively into that put wing, you should see vol come off, and that's kind of what we saw out here. That said, Mr. Nick, I know you have the QuikSkew up and running, so you can give us your deep dive into all things soybeans volatility skew. Have at it, sir.
Yeah, well, I think as far as the collars, somebody asked last week on the show, and there was still a little room to move there, but I think that ship has sailed. So generally across the board, Oct, Nov, Jan, March, May, July. Well, there might be some out there in May and July still, but there's not a whole lot of open interest out there. But as far as the first two front months, where the majority of first 2 or 3 contracts, where the majority of the open interest is, that skews basically, or our risk reversal is basically down to zero and even slightly negative right now. So we went from being massively bid on the call side, like we talked about over the last 6 or 8 weeks, to basically a perfect smile. So if you go look at that, if you go look at the vol curve right now, you have your standard volatility smile with puts and calls bid above the at the money, and not by that much all in all. So. But like we've talked about before with the QuikSkew, and I think I put that out there earlier, but if I didn't, I will punch it out there in a little bit. I'll put that chart out there. But that's what we talked. We talked about the trades many weeks back, how we took advantage of the calls being bid and the puts being offered, and we put some things on, and I looked at those, and I think one of them is doing well, and one of them is pretty flat to a little bit of a loser, but. Last week when we talked, the one that was flat to a little bit of a loser was in a good place. So, again, not being right or wrong about the trade, the whole idea behind that QuikSkew and any kind of information you might be able to find that we talk about or that we put out there, especially in relation to the skew and talk about the collars, is the fact that those things are going to move back and forth. And moving back and forth between being overpriced or underpriced, rich or cheap, however you want to look at it, it's going to provide trading opportunities. So, if you get a chance to take a look at some of that stuff and look at those charts, you're going to see that there's definitely, even in low volatility markets, there's going to be some opportunities there, because things are going to kind of revert back to the mean or go back to where they were normally. So you see a crazy looking vol curve for a particular month or for a series of months, there's a chance that you can do something there and make a trade, put something on, have a little patience, and see it come back. As far as looking at, let's look at some of the numbers. As Mark mentioned, it got plastered pretty good the last couple of days. It's right back below $10, and it's settling, as you might have mentioned already, around the 30-day moving average. In the front contract, we have, I'm going to pull this up for verification. Let's look at the November contract, because I think that's the new crop, right? So we have our max OI is between $9 and $12. Okay, so and if we want to get picky, we could say that the $11 call and the $12 call are essentially a wash in terms of total open interest. So, when you start to look at that, and again, we talk about it, it's purely theoretical, right? It's just we're looking at charts and looking at the way the futures are moving and how things are trading and where the volume is and where the big OI is. But, without anything spectacular happening, you can maybe expect to see a range between $9 and $11. So on the contract. So, there's again an opportunity to think about what you might want to do. Look at the strikes outside that range, see how those strikes compare from an expected range standpoint. So if I look at the expected range tool we have on there, our one standard deviation with the current volatility of like 19.25% for the November contract in beans has a price range between $9 basically and $10.50. So that 9 and 11 from an open interest standpoint is essentially standing outside of one standard deviation move in the November contract as far as the current volatility goes. So again, say what you want in terms of what that all means, but we all look at the numbers to make some decisions. So you have two strikes that have high open interest that are outside a single standard deviation. So maybe there's some trade opportunities there. Overall, as we mentioned, OI is pretty flat, a little bit of an increase, and we're going to lose quite a bit of open interest here when we already did. We rolled the September contract off that had about 225,000 in open interest, so that rolled off to this morning. So other things of note, as we've talked about, vol got hit pretty good there, about almost 1.5 to 1 3/4 vol off in the first 6 contracts, and that skew, like we said, is right. It went from positive to negative. So, but the way it's moved and the way it looks, it's basically pretty flat. So the beans, again, I think it looks like that party's over in terms of taking advantage of those collars. But maybe it's going to go the other way now, depending on what some of the news says and what the weather looks like and that kind of thing. So we'll have to keep an eye on that and see what happens. And as far as craziness in this thing, I didn't see really any crazy strikes in terms of volume or anything like that. There was basically trade around the money, and that's probably going to be the case, within that 9 to 11, $8 to $12 range. That's where you're going to see your strikes trade.
Let's move on to the shiny stuff, another product a lot of people like to pay attention to out here in futures options land. Before we do that, Mr. Nick, we put out a fun little pop quiz here for our listeners over here who follow us on Twitter. If you're not doing that, at Options on Twitter. Follow Nick as well at QuikStrike1. Don't forget the 1 and no C. QuikStrike1 to get the latest coming out of him. And we asked our listeners, what do you think? Well, we talked about since we're talking gold, and we talked silver in the past. Let's do a little gold-silver combo here. We asked you, the gold-silver ratio reached about 80, actually sometimes surpassed 80, about 4 times over the last 25 years. We asked you, what do you think is the lowest it's been? We gave you the choices of below 30, between 30 and 40, between 40 and 50, and above 50, so greater than 50. Nick, a little more time left on the poll, but if you can resist cheating yet again, what do you think is winning the poll? And then you can give us the answer because you kind of came up with the question, so you know the answer. And then also maybe if you want to, some people may not be familiar with this ratio, kind of break down what the gold-silver ratio is and why it's significant.
Well, I brought it up because I had just read a few things about where people tended to think this thing should trade. So, you see an interesting article, then you start looking at the same kind of stuff in whatever tools or package you have available. So the ratio is just the price. It's just a 1-to-1 price over price. So as you mentioned, we hit 84 times over the last 25 years, and I wanted to take a look after I saw that in terms of where the lows were. But the chatter, at least in the articles that I read, was that it tends to be, if it gets around or above 70, you want to get short the gold and get long the silver when you see that sort of ratio. So that's kind of how I was looking at it. I want to see how often that happened. I was trying to come up with maybe a little bit more complicated or complex question, but I thought that the range up or down would be interesting enough. So what do people think? I'm going to guess that people thought, what was the second one, between 40 and 50?
Yeah, between 30, it was less than 30, between 30 and 40, between 40 and 50, and greater than 50.
I'm going to say people did between 40 and 50 without looking. I didn't cheat or anything. So that's just going to be my guess because, just sort of think. See, now I was surprised personally when I did the research for it because I had recalled silver run up at some point, but I wasn't necessarily paying attention to the metals as much back then. But that's going to be my guess. So you tell me, what are we thinking?
All right. Well, so far with our polling, we got about an hour left to go in the poll. So it's winding down. So far with our polling, the winner with about a little more than a third of the votes is less than 30 with about 36%. Number 2 is between 30 and 40 with about 27% of the vote. Then number 3, 19% say above 50. And then 18% say between 40 and 50. So more of the story, Nick, is that our listeners are all over the place with this one, which makes it kind of fun. Maybe a lot of people maybe are not that familiar with the ratio or kind of have a broad range of estimates, which is always fun. So if you, go ahead, sir, regale us with the answer. I know you've been doing the homework and crunching the numbers here during the show. What is the answer? What is the lowest it's been over the past 25 years?
Yeah, the answer. I don't have the exact. I have the about number. The lowest is around it was in April of 2011, and it was between 30 and 35. So it was not quite below 30, but it was between 30 and 40. So we had
our number two.
Didn't spend a lot
winning.
of time there. Didn't spend a lot of time there. It was probably for the better part of that April in 2011, and went right back up.
Good stuff there. So listeners, we kind of cheated, but you guys listening in the Mixler live stream can run ahead and take that info and goose the numbers a little bit. Those of you after the fact listening on demand, the poll will be closed, unfortunately. It's just a pop quiz just for the time of the show. A strong incentive to come join us live during the show. We'd love to see you guys in there as well. But Nick, let's get into the shiny stuff this week. You know, we're talking about a volatility skew, and I don't know if there's been a product that has exhibited more flux, at least not a major product that a lot of people trade, more volatility, skew, flux, evolution, call it what you will, than gold over the past few months. Like I said before, you know, we saw post-Brexit, everyone and their mother had to pile into gold. It was a straight-up wall for the calls. You couldn't get them. They were super rich. In the subsequent weeks, the puts gained some favor, and then they became effectively, they started leading the dance, and the calls back in favor. And then for the last few weeks, we've had a relative parity between the two. If you look at it right now, they're in a slight bias to the calls, but overall, there is relative parity, getting back into that kind of smile scenario with a slight bias again towards the calls. So that is kind of where we're seeing right now. A lot of people kind of up in the air about where they think gold is going in the near future, and that's reflected, of course, in the paper flow out there. In terms of where the action is, gold is, unlike soybeans, gold is kind of heavy on the front month. It tends to pile up that area with about the OCT contract leading the day with about nearly half of the paper over the past week. And of that paper, we have 1,300. Again, round numbers, just fixate people, and so many products across the board, including gold. 1,300 puts lighting it up with nearly 4,000 contracts this week. Overall open interest up a little bit this week, a little over 3% out there in gold, but not the most rock'em sock'em week. You might think gold would be lighting it up a little bit, just given the fact that Miss Yellen was on display yet again today, her and her team doing their will they, won't they dance. That always causes some activity out there in gold land, but the 1,300 puts where the action was this week, followed by the 1,200 puts actually out there in December, the number 2 contract for the week. So interesting stuff. Puts lighting it up, perhaps showing that maybe going forward we'll see some of that skew start to revert even more, and maybe we'll see puts kind of balance it out, and it will be once again back in symmetry. The futures giving it up a little bit this week, off about 20 handles. They were about 1340 last week, closing around 1320 at the end of this week, and all of that brought a little bit of vol in across the board out there in gold. Most of the contracts off about half a point or so from a vol perspective over there. Also, some interesting stuff out there in the skew. And Nick, I know you have the QuikSkew up, so if you want to dive right into that, sir, have at it. What caught your eye out there in QuikSkew land as well as broadly with the shiny stuff?
Well, as you mentioned, we're off about 20 handles, but today, and it must have been, and again, I was doing some other work. I wasn't listening to the news or anything, but we did have a spike back up almost to hunch on the week, up to the 1342 range, which was basically where we started the week during some of the talks, and then we came right back down. So there was some movement, and I'm sure there was some pain in that $20 move that seemed to occur pretty much in the middle of the day around 10 o'clock. So we really were down to start over the last few days, and then we had a big spike, and then we came back. We're pretty much where we were on the open today. Not like you said, nothing really catching the eye in terms of craziness and strikes. Some 1,700 calls traded out in February, but not for not for a great deal, about 375 of them, and those were openings. So again, you don't really know what people are thinking, or, I don't know what the premium on those are right now, but you wonder what the reason behind that trade is. But that's sort of maybe the marginally crazy or the bit loopy trade of the day for the gold. But vol off to we'll call it steady. It's off about 0.25% across the board, 1.25%. So nothing much there. And the thing to keep in mind, you're getting movement in the underlying, and that movement is basically enough to support the volatility that where the gold is trading at right now. So it's not surprising that the vol was kind of steady, even though we did have a move down, and then we're in another little short-term range. We're in a short-term range in the beginning of the week, and then we came down, and now looks like we're in another range. So again, we'll have to see what happens if we continue to be rangy. We might see that vol drift down a little bit, but it is pretty low. It's been drifting for a while now. As far as the skew, not much change there. Still a little bit of a bias to the call side, but it's slightly less positive this week than it was at the end of last week. But still, we're going to call that, I think we just want to probably call that a smile right now, what we're looking at. So if I see what that curve looks like, generally we're looking at a pretty even smile, maybe with a little tilt, like we said, to the call side in terms of those being a little bit bid. But that skew doesn't look like it's changed all that much over the course of the last few months. Maybe the puts are a little bit better bid than they were back in late May. But that's about it. Like you mentioned, increase in open interest is always good. Majority of that increase took place in the first 5 or 6 contracts. But again, and these are other, Mark, I don't know how you feel about it, but we're at the end of August now. You're going to see a lot of people who have been off coming back into the fold, right? Because it's the end of the month. Maybe we have one more week of a little bit of slowness if people are going to be coming back from holiday or are going to continue to take their extended holiday through the Labor Day. But, there's a lot of, I think we're going to see people come back after this holiday and see where volatility is. And we might have to wait a week, but, I think we're going to get a little bit of a bump just because if it's been sitting around or trending down and the futures haven't moved much, there's always that opportunity that you got to look for where something's going to happen.
Speaking of something happening, Nick, let's make something happen right now. Let's make some dreams come true with our futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, Nick, it's that time of week, time when we answer some of your questions out there. Got a bunch of interesting ones. I like to give our loyal listeners and question askers some pride of place. This one comes from Fred. I know he listens a lot, and he also, I think, is part of that part of the Top Step room over there. I beam in there once a week, and he asks all kinds of questions there as well. He asked about crude oil. He says, "Thanks for the crude oil talk. Crude is trading, according to him at least, trading above 3 moving averages. As long as crude remains above these levels, I think it's in an uptrend. If I wanted to buy a weekly call expiring Friday, would that be a good idea?" It's this is an interesting question, Nick, because it kind of involves a couple of different aspects. First off, the weeklies, kind of a topic you and I have addressed quite a bit on this program. Crude lights it up. WTI lights it up. The weeklies, not so much. They're not the volume leader out there in WTI. I'll see if I can pull up, maybe Nick, while I'm talking, you can pull up some of the spreads and strikes out there. But usually when things are a little less active, that is reflected in the spreads. They're not exactly as tight as you may like. So that could involve maybe having a little bit more cost, a little bit more slippage in terms of execution and transaction costs when you're buying a weekly. That said, if you are so inclined, if you're bullish, sounds like Fred is here, then buying the calls, I can probably get more behind that than really just straight up loading up on the puts. As we talked about earlier, all these things, the puts are kind of jacked up quite a bit right now. The calls are a little bit more of a value from a volatility perspective. Again, we're talking weekly, so it's kind of hard to really talk volatility. Weeklies are primarily a gamma-oriented instrument rather than volatility. But that said, it is richer in the put wing than in the call wing. So you can save yourself some money if you are indeed so inclined. One of the reasons I put out there in our poll this week for USO, but you can apply the same logic to WTI, one of the reasons why I put the bullish risk reversal out there is I think that's maybe a more attractive setup than just straight up buying the weekly call. If you're not familiar with it, listeners, a bullish risk reversal, selling an out of the money put, buying an out of the money call. What you've done effectively now is taking advantage of this very, very skewed, pun intended, volatility skew here that is heavily skewed towards the puts. So the puts are more expensive from a volatility perspective than the call. So if you sell the rich portion of the volatility skew, maybe you identify a level in WTI where you're comfortable buying it, 45, let's say, 42.5, whatever strike suits your fancy, and you use that premium you collect from that to buy a call on the upside, maybe the 52 halves, 50, somewhere along that line. You could line them up differently depending on the months and the strikes and find the balance of debits and credits that makes sense for you. But that way, you're not just straight up laying out money for a call, which is a difficult road to hoe. You need a lot of movement very aggressively. Weeklies are a high decay instrument. That's why they're very popular with premium sellers. If you were just coming in and just buying them outright, it can work. We've certainly seen crude move quite a bit intra-week, and next week could indeed be one of the weeks. But I'd prefer you to take an approach that's a little bit more premium neutral, so your risk is more mitigated in that sense. Obviously, there's downside risk from a WTI perspective, so that's why I encourage you, if you do take this approach and you're writing the put, find a strike you're comfortable buying WTI at. So if you're happy buying WTI at 42.5 anyway, then maybe it makes sense to write that put there and use all of that premium to offset the cost of that call. And now you're not out anything really, but just the margin that's tied up to cover that put to the downside. I prefer you going that way, but I think that could work. And if it doesn't work, guess what? You haven't really cost yourself anything versus if you bought the call and it doesn't work, now you have to pony up again and it costs you money, and it's not a situation anyone wants to be in over the long term. That said, Mr. Nick, what are your thoughts here on our friend Fred piling into the WTI weeklies? Any thoughts on maybe any spreads out there, and just your thoughts on the approach in general?
Let's see. So I'm going to put this out on Twitter. Okay, so I tweeted a weekly pricing sheet. I looked at the futures chart too, and I see what he's saying about the price being over 3 moving averages. At least on our futures chart, we have it over the 30, 60, and 90-day moving average. But frankly, it's been over the moving average for much of the last calendar year for the most part. It's been well, at least in like the beginning of April. But like you said, if you are bullish and you tend to think that we're going to go higher, I agree with Mark that a collar of some sort might be better suited for you. If you look at the pricing sheet I put out there, it's going to show little markers on the left-hand side of the pricing sheet. It's going to show 1, 2, and 3 standard deviation ranges given the current volatility for the weekly expiration. So yeah, if you have an idea of where you think we might be going on the upside, maybe look for. And as Mark also mentioned, the volatility was a little bit juicier on the downside. Maybe look for a put that's in a little further out standard deviation to finance a call that's in a little closer in standard deviation from a strike range standpoint, and put your play on that way. Because, Mark makes some good points. There is high decay. You have 6 days. You're going to lose. Obviously, the market's closed for the week now, but you're going to lose. You're going to lose even more time decay over this weekend. So you're going to come into next week with like basically a 4-day option. And, if you can get it cheap enough, or if you can finance it with a good enough put, and you're comfortable with that downside, then, it's maybe not a bad idea. But as an outright play, I'm not, if you really believe it, then it's probably okay. You're never going to get hurt buying premium. but you're going to lose premium if you buy premium that doesn't go your way. So you always have to balance that. So collar might be a good thing here.
I got time for one more quick one here, Nick. This comes from Chad Stickforth on Twitter. He says, this is in response to you asking people last week, or this week actually, what do you think people's interest is in some sort of a Q&A explaining all these different features we're always talking about here on not just QuikStrike, but on the CME Group version of QuikStrike, the free stuff over there on the CME Group. So if you do go over to cmegroup.com/TWIO this week in options, leave off the F for fun. Just this week in options, and you thought maybe put together a nice webinar for people kind of explaining all they can get for free. A lot of people responded to that, including Chad. He says he could noodle around a bit and figure it out, but he thought maybe a quick overview may be in order. So what are your thoughts here, Nick? Did you decide you're going to do that? And what are your thoughts to people regarding maybe setting down some explainers for all these cool tools you have over there on the CME Group website?
Yeah, I agree with Chad. I think that you generally get people for about 30 minutes in terms of paying attention time. And after that, people want to start playing around themselves, or they have other stuff they want to do. So I will look into setting up a webinar, and we'll go over specifically probably QuikStrike Essentials. We try to, that's the free version there that you can register on the CME Group website. And what we've been trying to do is beef up Essentials to essentially have all of the free stuff that's located at different parts of the CME Group website. But this way you have it all in one place, so you can log in and get at it without having to jump around specifically on their website. But yeah, we're going to do it. Probably we'll wait until after the Labor Day holiday, just to get everybody back and to get as much interest as possible. And if nothing else, I'll throw the current YouTube video that's out there explaining QuikStrike Essentials and the free tools. I'll make it more available and tweet it out there so you can at least find it. But you can always go to YouTube/QuikStrike1 to get at what's available right now.
There you go, Mr. Nick. Check out Nick's existing video, and then we can keep our fingers crossed on a cool demo, a cool webinar coming down the road, explaining all this stuff in a lot more detail. Uh-oh, Nick. There's that music. It means we've gone long yet again, but we have so much fun doing this show that we always run a little bit long. But we're getting the hook. We gotta go. So, before we go, though, Mr. Nick talked a lot about all the different cool stuff cooking over there in QuikStrike. If listeners want to learn more, you guys always have cool things. In fact, you're always adding new stuff to my platform right before the showtime. Sometimes it throws me off. What is this new thing you've added? So you're always adding new cool tools, new cool functionality. What are you guys working on? What's coming down the pike over there in the land of QuikStrike that may intrigue our listeners?
Okay, good. I actually took some notes on this. So finally, the TWIFO reports are going to be released within the regular version of QuikStrike. So if you are a listener and you have a subscription, you're going to be able to click on the different cells within the report and see in great detail the things that Mark and I talk about on a weekly basis. So look for that to be out there. And we're also going to be releasing another end-of-day Delta Vega report. So take a look at that, and I think you might find some value there as well. Another thing to keep in mind, if you are on either of the sites, the free or the subscription, we're going to be merging the index products, so it's a lot easier to spread and compare the E-minis against the weeklies, against end of months, all that kind of stuff. So that's a big one. And then I've been talking about this heat map. I've been tweeting a lot of stuff about it, the open interest and volume heat map. That freebie version is going to be out there probably the first week of September. That's when the CME is going to be releasing it to the public, I think. It's in there, sort of hidden in the option matrix and our regular stuff. So if you have any questions or you're out there and you want to look at it and you're in a trial period on the professional edition, give me a tweet or shoot me an email and I'll show you how to get at it. In the meantime, otherwise, look for it in a couple weeks.
All right, thank you for that, Mr. Nick. I can listen to that funky tune going all day, but unfortunately that brings to a close this episode, this long-ranging episode of TWIFO. We hit on some crude versus USO, gold versus GLD. We hit on soybeans, of course, answered some of your questions. I went down the rabbit hole of all sorts of fun stuff, and of course brings to a close this episode as well as our broadcast week here on the Options Insider. We encourage you guys, if you can, do so. We'd love to see you join us every Friday, 3 p.m. Central, 4 p.m. Eastern, for our live stream of TWIFO. This is where Nick and I get together. You can see how the sausage is made live. Of course, a lot of you guys can't make it. You can join after the fact. We love you guys too. Hit us up via the website or via iTunes or TuneIn or Stitcher, wherever you find your favorite program. While you're listening, if you like what you hear, leave us a nice little review. It's a brand new program, so some little feedback always helps. And we'll see you guys next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.